As the regulators have said, the U.S. tariff policy has brought great pressure to China's capital markets. They've also singled out the property market, which they are looking to guide financial institutions to maintain a steady financing support for the property market. Let's talk a little bit more about the Chinese economy. We've heard in recent weeks from the IMF, they have lowered the growth forecast for China to 4% this year. UBS has put it at 3.4%, if I'm not mistaken. What is your take? China is not going to be able to hit its annual target this year, is it?
Well, it seems optimistic, but you never know, given that some of the, China's obviously, the government's very willing to try to reach that 5% target in one way or another. Now, I mean, looking seriously at the different sectors and how they drive the economy, the one sort of positive news over the course of the last 6 to 9 months or so, I think, has been the fact that the construction cycle looks like it's stabilizing. So if we go back and look at the big source of weakness in China since 2021, it's really the three red lines and the collapse in the property market that's happened since then. So what's the big change that's happened recently is that the construction PMI has stopped falling. So that is an incremental positive piece of good news, which does change the macro picture for China. Now, at the same time, where we're going from here is that it's likely exports are going to be slowing down from where they have been. And so if you look, if you think about the kind of rotation we've seen in the economy, it's been away from property towards exports. Now it's going to be away from exports towards something else. There's still nothing in the property market that suggests that construction number is going to start to pick up. It started to not get worse, which is a second derivative improvement. But obviously for the markets, they would like things to be getting better, and there's no signs of that. So I still think that what needs to change from here is much more focused on consumption and much more focused on fiscal support for the consumer in China. If that starts to happen, I think that makes a material difference to the outlook. Without that, I think we're sort of still in the same holding pattern as we've been really over the course of the last 6 months, since all of the excitement around the joint press conferences that were held from September and the bounce in the stock market that happened thereafter. If you look at where equity prices are today, or where interest rates are today, they're not hugely different from where they were after the policy boost that happened in September. And I think that's very reasonable given all of these cross currents that are happening in the economy. And where we look at things today, despite the announcements that have happened over the course of the last couple of hours or so, there's nothing to me that suggests we're going to be out of that sort of trading range or this sort of treading water period for China over the course of the next few months. I think we're still very much in that holding pattern.
It's very interesting that you say that, because I did make note that the CSRC says that it will forcefully promote long-term capital into the stock market. So when we talk about confidence, we need to see it, of course, in the stock market. We need to see it in the property market in order for there to be consumption, for the residents to be willing to want to spend into the economy. Talk to us about the Chinese currency, the CNY. We've heard from the PBOC that they are intending to keep it stable, so there isn't going to be any huge depreciation in order to fight back in the trade war.
Well, so we can start with the first point that you raised, which leads on to the currency, I think. So thinking about, confidence in the economy. I think the other way of framing that is to think that inflation, confidence is really all about inflation expectations. Do people think that prices are going to rise, or do they think that prices are going to fall? If they think that prices are likely to fall, not only will consumption be less, but I think the other thing which is often missed in the debate is that means that money is much more likely to be remaining in the banking sector. And because of that, it's not being used. There's no velocity across the economy. You don't tend to see activity picking up in either financial markets or in consumption. So I think, to me, the critical issue right now is really still that inflation is very low, core inflation is low, PPI inflation is low, as the recent PMI suggested. And if that's not addressed, it's unlikely, I think, that in and of itself calls to increase consumption are going to be enough. There has to be something that boosts inflation. Now, why is that relevant for the currency? And obviously the PBOC wants the currency to be stable. They don't want to see a big depreciation despite the pressure that's coming from the US. Why is that inflation picture important for the currency? Because obviously it impacts what's happened with interest rates and interest rate differentials. Now, I think we have seen these measures today in part because the US dollar has been somewhat weaker than it was before. And, it does look like China tends to react when the dollar is a bit weaker. It gives China a bit more monetary policy flexibility in the short term. But I think unless we see inflation stabilizing, nominal interest rates in China rising, and you showed the chart earlier of the 10-year yield in China, which still remains very low, unless those things start to pick up, it's very difficult to think that we're going to see a huge rally in the currency, even if the US dollar weakens. And that then reflects on the rest of the region, where it's much easier to see other currencies appreciating rather than the CNY in this kind of environment, given the different macro pictures that some of these other economies have.